Um, recorded. Okay, sounds good. Can you see the presentation?
Yes, we can see it, Brian. It's not in presentation mode yet.
Okay, yeah, I'll probably leave it like sometimes presentation.
Okay. Okay, great.
But hey everybody, my name is Brian Davis. I've been in the finance group more or less for about 20 years. My current role is Director of Utility Finance. Took that job over the summer, but I've been in the finance group, like I said, for most of that 20 years. Spent some time in accounting when I started out, and jumped around to different jobs. But so quite a bit of experience, mostly supporting PSE&G. Hence, I have some knowledge about this topic. Excited to be here to go through it with you. I know I did like a how utility makes money thing for Zishan's All Hands back in August. So some of you might have seen a related topic to this. It was a little more high level. We're going to get more into detail. Trying to specifically give you a background of how IT projects get into our costs and revenue streams. So please stop me if you have any questions as we go, and let me know if you see any issues. Okay, so the first couple of slides are actually presented at that All Hands, but for those people that weren't there, and kind of a refresher, giving an idea of what the background is on this, and just kind of high level how we make money, if you want. So PSE&G is a monopoly, a pipes and wires business that distributes electric and gas for our customers. We have no competitors for distribution side of the business. So we're highly regulated, both at the state level and at the federal level too, by FERC, and we'll talk more about that in a second. So working with our regulators is a big item for us. But given how we get a return on our money, this is sort of like a stated way for all utilities how this works. This isn't just specific to PSE&G. So basically, we get a recovery on any capital investments we make, recovery on and of that, as we call it. So the recovery on it means we get our cost back. Recovery of it means we get our cost back. Recovery on it means we get a rate of return on that, which is essentially goes to our net income. So we work with our regulators to figure out what those returns should be, and the different methods we come up with recovery mechanisms for each of those. So this slide kind of lays out what the key items are. The big one for us is rate base. The way we grow our earnings in our business is by investing in capital items. We'll show you how IT gets into that bucket. The rate base is composed of your plant, property, and equipment. It's more or less your cumulative amount that you've invested in the business for capital projects over a long period of time. And accumulated depreciation is subtracted from that, so that we'll talk about how you get depreciation in a sec. But that's basically the amount that those capital items, the value of those has gone down over time. That picks up that amount. And then we also have deferred taxes, which is basically a timing issue from when we get a tax incentive from the government to do investments. We basically give that cash back through this rate-based calculation. So what we do is we'll invest in all these items, inclusive of IT, but bigger investments would be like in our pipes and wires business. So all the programs we're doing, like gas system modernization program or GSMP or Energy Strong, or even base spending. So we're replacing pipes and wires, upgrading transmission lines, things like that. All those go into our PP&E number, and we earn on that over time. So we're incented to invest in things and improve our reliability of our operations, make our IT systems better, improve reliability for customers and their customer experience. So all that goes into those calculations. And then we work with our regulators to figure out what the proper return on those investments should be. And we also get to recover our expenses. Those include operations and maintenance, depreciation, interest, and taxes, kind of the main ones. Like I said, this formula kind of works for all of our different businesses and really utilities all over the world. We have different types of regulation for our distribution and transmission businesses. So different ways that we recover these items, which is really on the next slide. You know, unless someone has questions, I'll just keep going, but please pause me if you have any questions on the first part of this. All right, so this slide lays out what the difference between our transmission distribution businesses are. I don't want to get too in-depth in it because I think we're more focused on the IT part of this. But more or less the takeaway is the transmission side is a formula rate style that we call it. So we file every year with forecasted costs, including capital and O&M. And we get recovery on that pretty much contemporaneously. So we'll file in October. We start recovering those costs in January. So basically, as we spend the money, we're getting recovery on it, which is a great system. It also has a little bit of a higher return on equity, which is ROE. So that's how much our shareholders make. So this just changed recently for transmission, but it's still higher than the distribution side. So we're at 10.4% transmission, 9.6% for distribution. The distribution side is a lot more complicated. We have a couple different ways we recover our investments. I group renewables in with distribution, even though we more or less treat it as a separate business. It is also regulated by the State Board of Public Utilities. So it keeps the same ROE as our distribution, but it has a more contemporaneous recovery method. So similar to transmission, we file to get those costs recovered, but we do book the revenues as we spend the money. So that works really well. We do have to file with the state to get those programs approved. So really the work with the regulators is on the front end. We have to put a filing together that states what we're going to do, how much money we're going to spend, what the benefits are. And then once that's approved and we stay within the spending limits and we properly show we spent the money prudently, we're able to recover that right away. In between that, we have some programs like GSMP and Energy Strong that I mentioned that we have kind of intermittent recovery. So we don't have a contemporaneous that we get it right away. We have to file with a lag in the recovery. So it's like every 6 or 12 months we file with historic information. So that's like the big programs that we have are covered through the renewables or GSMP, Energy Strong type things. And then we have our base distribution spending, which is kind of a traditional recovery mechanism that we get through filing a rate case. So those are done intermittently. We're on schedule to do one every 5 years or so right now. The last one ended in 2018, scheduled to file the next one and finish it out in 2024. So 5 to 6 years between when we file and recover it. Those are much more cumbersome. There's a lot of things we have to file with the regulators to prove that we spend prudently. They ask a ton of questions. It's just a very long process. It can be very contentious. So we try to get as much of our spending into contemporaneous or near contemporaneous recovery as we can. So obviously, that's much more beneficial than waiting to get recovery on it in a contentious situation. So I brought this slide up only because it kind of sets up how we recover our IT programs, because they really do fall within, mostly on the right side, but with different mechanisms.
I have a quick question, Brian, if you don't mind, if you are willing to entertain questions before you move on. But
absolutely.
and maybe you'll cover this later, but is there an impact? So when you're getting ready for these rate cases, or when you get this funding, if we say we're going to do a capital investment, we forecast it to be done in 2021, and then it doesn't get put in service in 2021, meaning it gets pushed into 2022. Can you talk at some point a little bit about the impact from a recovery standpoint for those costs? Or is there an impact?
Yeah, I kind of get to the last slide, so I'll talk
Perfect.
about that.
Thank you. Thank you.
But yeah, that's obviously an important part of it. So, but that's a good question. This background kind of gives you an idea of the different recovery mechanisms, but the last slide we get a little more detailed as to how we will recover the cost. So I think that'll be a good time to cover it. Before we get to that, though, I wanted to go through, if there's no other questions on this, the different types of costs that IT projects have. Okay. Yeah, just stop me if you want to go back. That's fine too. All right. So I want to get into this part because this is probably more of like an accounting type discussion, but I think it's important if we're trying to get into more of the details on how IT impacts things. So it's kind of covering where do the costs that we spend on IT, where do they land? There's a couple different places. High level, they either go to the balance sheet or the income statement. Costs that go to the balance sheet, similar to all our other pipes and wires and renewables type investments. Those are, we'll call them capitalized investments. Or in the case of like cloud-based software, we don't technically call it plant, property, and equipment, but it's still put on the balance sheet as deferred O&M. So this is really the implementation cost for any IT program. We'll capitalize the labor, materials, outside services, like consulting costs. Those get put on the balance sheet, assuming they're over $250,000 for that project, cumulatively. The only thing we don't capitalize that would be sort of an implementation type cost are training and data conversion. So in theory, we do segregate out those costs when we're doing the work and implementing a new program. My understanding is if like an ERP system, if we're doing any upgrades or things like that, as long as they're over $250,000, those upgrades would also be capitalized. So I'm not sure we're doing any new SAP type things, but those types of projects would get capitalized too. So really the only difference between what goes into PP&E here and what we go like a deferred O&M type thing is obviously we're moving to all cloud-based software solutions because technically we don't have the asset on our premises. Accounting rules say we're not putting that as a plant, property, and equipment item. So basically it goes to like what we call a regulatory asset, or if you want a deferred O&M item. So both sit on our balance sheet and we'll earn a return on both of those and recover the cost of them. So that's really the main things is pretty much every IT project, because unless it's a real small one, any new software or upgrades and things, we're going to capitalize it. And then on the expense side, so the expenses we see, the biggest one normally from IT projects is depreciation or amortization expense. The sort of equivalent terms, a lot of times IT projects or IT investments will dub it amortization because it's not a hard asset, but they're really the same thing. So what happens is we make an accounting ruling, what's the useful life of the asset? So traditionally, like pipes and wires, we have a long-term investment there. Excuse me. So we'll have those in place, for 50 odd years. Things like smart meters that we're just putting in through the AMI project, those are more like a 20-year asset. So they'll have to replace every, 15 to 25 years or so. IT assets typically are shorter lived because, just with any IT type thing, the systems change frequently, the technology gets a lot better. So typically those are like a 5 to 10 year useful life. Something like an SAP or ERP replacement would be a longer life because we're not going to replace that, every 5 or 10 years. It would be like 15 or 20 years more likely. So those are usually set when the systems are first put in place. If the system is used longer than that, then basically we'll have, after, say it's a 15-year ERP system, it'll basically be worth zero on our books after 15 years. And the reason for that is the way depreciation works, it's essentially recognizing the cost of a capital investment on our income statement. So take that implementation cost or the amount we capitalize and put on our balance sheet, divide that by the useful life, and that's how much we amortize each year. So that's how much expense for that investment is going to hit our income statement each year. Pretty simple calculation, typically not that complicated. Like I mentioned, if we're not very good at replacing IT systems, the end of their useful life, we'd like to stretch those out. So sometimes we do reach the end of their useful life and they will be worth zero on our books, but still be used and useful. And at some point they will be replaced and then a new asset would take its spot. We'd retire that asset off our books and put a new system in. The other big item, and most of this will be licensing costs for IT things, will be O&M expense. So obviously as we put systems in, we have to pay the software provider license cost. So typically that's the big expense we have on our books besides depreciation for IT. If we choose to pay that all up front, we can capitalize the licensing costs. I don't think we typically do that. I think we typically just expense it over time. It's a pretty big capital outlay at the beginning of a project. So I'm not sure we have a policy on it, but I'm not really sure if that's a typical thing or not. But my guess is we usually just have the licensing costs as an expense each year. And then if we do any kind of smaller patches, repairs, whatever have you with any IT system under 250,000, we have to expense that. And kind of an indirect expense from really any capital project, IT included, is interest expense. So in order to pay for the stuff that's on our balance sheet, typically issue or have a mixture of debt and equity to fund that. So it's roughly 50% debt, 50% equity. And because we issue debt, we have to pay interest on that. So the interest would be another expense on our income statement that we're paying. Any questions on that?
I was wondering, do we lease any of our IT infrastructure or is it all owned?
Leasing IT stuff. Not, I don't know. That's a good question. I really don't have any idea. I know if you have a lease that is like a long-term investment, they basically treat that, the capital lease. So more or less gets treated as like a capital item. I guess if you're doing like a short-term lease, might be a cost that would show up on our income statement.
I was coming over.
So it'll probably be similar to like a licensing cost, I would guess.
Thanks.
Yep.
Also, after decommissioning an IT asset, are there any instances when you would recognize salvage value, or are there any residual salvage value after decommissioning?
Yeah, for IT, I wouldn't think so. There might be, for software itself, there wouldn't be, I don't think. We have like hardware and things that, we could salvage and someone to pay us for it, that would be a value. That would be a reduction to our capital amount. But I think typically because they age so quickly, there's probably not a lot of salvage value there. Be my guess. I give you an example. I think we, like our computers, we amortize or depreciate those over 3 years. In 3 years, a computer is probably not worth much. Okay. So getting into recovery of it. So one important thing, I added this to the slides kind of late. One important part about utility accounting is when a project is being implemented or under construction, we earn this thing called allowance for funds used during construction. What that is sort of a non-cash return on our investment. So the idea is you're offsetting your cost of debt. You're also earning a return on equity of that. So that both your debt holders and your shareholders aren't out any returns during the construction period. Once it goes into service, which is if I go back to the first slide, PP&E is typically an in-service item. So once the project is done, at that point, the AFUDC goes away. You start depreciating your assets. That's when we start seeing the negative impacts in our P&L, our income statement. While it's in construction, we're more or less getting a rate of return on it equivalent to our normal return. That would be if it's in rate base. It's just we're not getting any cash for it. Get that cash in the future. So like most of the projects that we work on now are smaller. A big one, replacing SAP, that would be a big item. That would probably be, hundreds of millions of dollars or whatever we're going to spend on it. And it's going to take a long time. That's an important time that we would have this allowance for funds used during construction. So basically our financials are not impacted negatively during that construction period. And to the question earlier about, timing of recovery. So actually I don't really talk about this a little bit. I get it down here, the lag in recovery. I'll go through kind of the easier ones first, the transmission and renewables thing. But even before that, if I split up types of projects or costs into 3 different buckets, things that PSE&G spends, the regulated utility, service company costs, and then power and holdings. So if I go down to the bottom, power and holdings, so there's no affiliation, power and holdings and PSE&G, so there's no recovery of those costs through the regulated mechanisms we have. Service company is a little bit tricky, so I'll hold that one till later. At PSE&G, we do get a return on rate base plus our depreciation and O&M recovery back. And the return on rate base is inclusive of our interest cost. So the timing of that really matters depending on what type of investment it is. So if we did something like for our transmission business, so I think recently there was some like that, not the outage system, but their transmission network software got replaced. So say they're replacing that. The way we have kind of a funky mechanism with IT type things in general plant is we don't recover 100% of that if it's on our transmission books. We take the combination of all electric IT investments and then recover a portion of that. This is how we set it up when we implemented our transmission formula in 2008. The theory is that you don't have specific assets dedicated towards transmission investments, to transmission operations. So things like vehicles, computers, furniture, hardware, and things like that. And software, those can be used for all different businesses. So we take the amount of electric that's been dubbed the electric part of it and then recover part of that through the transmission formula. For renewables, which is, again, that's a state regulated thing. The two big programs going on now that have been approved by the BPU, the Clean Energy Future Energy Efficiency and the electric vehicle programs. Both of those have pretty sizable IT investments related to those. What happens with those is we file, or we get any, start spending anything, we file with the BPU. We say we want to do these investments, energy efficiency, we're trying to bring these efficiency measures to all our customers through a variety of things. And vehicles is, charging at home and also transportation corridor charging. But there's IT upgrades we have to do in order to make these investments work with our systems. So we include those IT costs in our filing, and through negotiations with the BPU and other regulators, we get approval to spend that money. But it's only a certain dollar amount. So it's not just an open checkbook to do whatever you want. We have to spend a certain amount that we can't recovery on. So basically setting the budget for it. So some of you might even be working on these projects, but they're pretty sizable, considering in the past renewables had very little IT investment included in the programs, even though they've been in effect since 2008. So it's a big change because it's a big change for the business. So what happens with that is we do get contemporaneous recovery. So as we spend the money, we basically get it back, both the return on it and the depreciation and O&M. The trickier part is with the state. So say it's a base distribution item. That would be a good example. So anything in like Damon LaBoy's area, any IT investments there that are outside of like an Energy Strong or something like that. Any systems that we're upgrading, say MDTs and things like that. We have to, ideally we could time that to when we have a rate case. So we have these things called test years for distribution. And I might have mentioned it. It's a 12-month period we look at, and at whatever we've put in our rate base at the end of that 12 months, start getting a recovery for it. If the investment happens to be just after the test year, so if we're using the example provided earlier, say 2021 was our test year, we put an investment into service in January of 22. That would be outside the test year, and we wouldn't get recovery on that until the next rate case. So ideally, we can time our investments to be within the test year or right before it. So this goes for all our investments, not just IT things. There's incentive there to not spend the money until closer to the test year. If the systems allow that, that's great. Obviously, you have to do certain things at different times. You can't always time things perfectly to a test year. So in this case, we're looking at our test year for the next rate case is supposed to be April of 23 through March of 24, which seems a little odd, but it kind of works out the way we're looking at it. So in that case, we want all investments in service March of 2024 or as close to it as possible. Sometimes you can pull in stuff a little beyond that, maybe a month or two, but it's just easier if it's all in at the end of the test year. And then the depreciation and any O&M and things like that associated with it, we should be able to get recovery on that from when the rates go into effect to collect that revenue until the next rate case. So that timing really matters for those base distribution items. The other ones aren't quite as important. So say like energy efficiency got delayed, delayed a year because of whatever happening. If we didn't do the IT investment, we wouldn't get the earnings on that, but we also wouldn't have the cost. So, you know, it'd be better to spend it earlier, but there isn't necessarily a negative financial impact from it. It just won't be as positive as we'd like it to be. But if we did a investment at distribution with no recovery, there would be a negative impact of it because you have depreciation and O&M expenses associated with that, plus the interest that you're not recovering. So hence the importance of trying to time that as best we can. Does that answer your question? I'm sorry, I lost track of who asked it.
Yeah, I mean, I guess I was just trying to get the point across of the importance of putting things in service in the year the investment was approved and the impact that it potentially could have on, say, a rate case or on recovering those costs. So I think you covered that.
Okay, yeah, good. It's different than, I know we're always, you know, we set budgets and timelines that we want to get our things in based on our business plan. This is a little different than that. Obviously, that would matter. The business plan aligning to the rate case matters more once we get to a rate case test year. Currently, because we're in between rate cases, there's almost an incentive to leave it in construction longer, assuming you're still working on it, because there's no negative financial impact from that. But obviously, you're doing an investment, you're doing it for a reason, and you want that system to be in place at a certain point. One important thing of with a lot of IT investments is, you know, we're replacing the old system. So ignoring the fact that the balance sheet value might be different, there was licensing cost and depreciation on that old system. So if you're basically replacing that with a similar investment, there might not be like a huge incremental cost from that. Whatever the difference is between the old system and the new system would kind of be the financial impact. Okay, and then the other part of this is service company. So obviously we do a lot of IT work on service company assets, and all of service company costs are charged out to the operating companies. So PSE&G, PSEG Power, PSEG Holdings, PSEG Long Island, they all get a portion of IT costs. Obviously, the biggest would go to PSE&G now, especially given the fossil sale, just much bigger part of the company. There's a couple different ways those go through. So if IT is doing work that is directly utility associated, that's like a direct charge. So 100% of that would go into utilities books. It could also be allocated. So something like our ERP depreciation or SAP depreciation, that gets allocated out based on like a three-prong type allocator. So those are typically the two different ways the costs get filtered into PSE&G. And they come as O&M expense. So even though it's depreciation on service company books, the charge comes over as a O&M item at PSE&G. And what we usually do, I don't know if this is just for depreciation, but we typically I'll call it gross up, but we add in a cost of capital on top of those costs that go over to PSE&G. That basically is the equivalent of the rate of return that we'll get on a utility type investment. So really from like a recovery point of view in terms of how much money we get back, you know, we'd obviously prefer to have an investment at PSE&G because that is, we get a return on the rate base there. If the cost is at the service company, we'll get recovery of that. We just don't earn a return on an investment. So basically, there's really not really an earnings benefit to doing an IT investment at service company that gets charged over to PSE&G. It's just that, we get this cost of capital tries to mimic that, but it's really just like a washout between service company and PSE&G. I think that was about it that I wanted to go through. Any other questions on that? Hopefully it's pretty clear.
I had just one. Does the latest infrastructure bill impact any of these energy efficient, these renewable efforts, and how you're handling those from an accounting perspective?
Not directly. To be honest, I haven't paid that close attention to it because it's taken so long. But we have to file with the BPU for approval for everything. And under most circumstances, we don't get federal funding for anything. We fund it ourselves. Like I said, we issue debt or we use our cash that we generated to fund our business. But normally there isn't a big alignment there between what the federal government's doing and what we're going to be able to do on our side. The only area I know that impacted things, and not this bill in particular, but Long Island had a bunch of money from the federal government to do upgrades. But we don't earn a return on that then. You're more or less borrowing it from them and paying it back through your customers. Yeah, so yeah, typically those things don't impact us too much. It might be beneficial for like private enterprises, especially if like renewables based things, if they're giving incentives for solar technology and things like that. Actually, the one area we do get impacted by are tax rates. So if the federal tax rate goes up or down, say it goes down like it did, 4 or 5 years ago, that helps the power business because they're paying less taxes and holdings. PSE&G, we have to give that back to our customers. The way it helps us though is our deferred tax amount goes down.
Yeah, that's what I was thinking. Deferred tax probably was impacted by that.
Right. Yeah. So our rate base actually goes up because of that, because your deferred taxes go down. So right now they're talking about, I think it's sort of dead now, but increasing the federal tax rate. So fortunately with the tax cut we had, we were able to give a lot of the cash benefit back to customers. That helped mitigate the bill impacts from like doing a lot of our investments. So that's typically like the federal side, how it impacts things. Things in the state, like the federal regulation of transmission, kind of outside that, the FERC is really more about approving rates of return for us. And the PGM regulates the projects we do. And then the state regulates everything else, pretty much.
Thank you. This was very helpful.
Good. Okay. Any other questions?
I had one. It's kind of unrelated, I think, but and I see this at the electric company where I live, and they're always promoting, energy efficient appliances. They even sell light bulbs cheap. I mean, ultimately, what I'm trying to figure out is how does it benefit the company if we're generating less income because people are using less energy? We must be recovering it in some way. Is that true?
Right. So where do you live?
Connecticut.
That's like CL&P or something.
UI, Avangrid, I believe.
Yeah. So a lot of states have these energy efficiency type programs. So I'm not sure ours aligns with that, but for us, I'm not sure light bulbs count, but things that we're doing through like the Clean Energy Future program, this guy here, the energy efficiency one. We're investing money, we're giving rebates to customers, and we're installing energy efficiency equipment. We're earning a return on that investment. So we get basically earnings from on that investment and recovery of the costs and things like that. The other part is we also have what we call decoupling now. So part of when this program got approved is now the revenue we're earning through sales. The sales and the revenue are no longer linked. So prior to this, every time someone used more or less electric or gas, we earned more or less, made more or less money. Now it's not tied into that anymore. It's really tied into our number of customers that are on our system. So we set like a base level of revenue we make per customer, and then multiply that times the number of customers we have. So, but it completely takes out the they call flow through, or no, throughput incentive. Trying to get customers to use more. I know like states like we're one of the few companies that earns a return on these energy efficiency investments. A lot of states, it's just a pass-through cost. So if they give you a light bulb, the cost of that they just recover from all the other ratepayers. So the incentive there for them is basically the state told them to do these things, and they probably have to spend a certain amount of money on it each year.
Some companies, I know my companies, it was also tracked back to generation. So if they had so much, say in the summer when you need a lot more generation, if they had to buy surplus, buying the surplus was more expensive than generating themselves. So they wanted to make sure they weren't in a position where they had to purchase surplus power from another company and charge that back. That was another reason. I mean, in the past, just for other companies that I've worked with, that was caused them to really
like fully integrated utilities. Yep.
Yeah.
Like the South is kind of really the only place that those exist now. But yeah, you're smoothing out the energy curve basically.
Exactly. Yeah. Demand.
You're trying to make it flatter so that you're running your baseline plants more, make more money from those. If you have to use your peaking plants, sometimes they're not as efficient, so you might make less money off of that. But yeah, the energy efficiency thing's a big deal. That New Jersey just got into it, but we have a very, very favorable treatment for energy efficiency investments. That one's going to be around for a long time, so it's a big change in the business. But definitely take advantage of those programs. Free money. I mean, they're basically giving you, if they're not giving you a full amount for free, they're giving you an incentive to do it or install a efficient appliance, that'll pay itself back over time. One thing I think we're trying to get into is make it more here, given we have no incentive now to have customers use more, is make that more of a cultural thing at the PSEG, because nuclear is more or less contracted power supply now. So we're not going to make a ton of money if we sell more from that business. And we have no throughput incentive anymore on the regulated side. So we're intended to have people save money and make money off that investment.
Okay, thank you.
Yep, no problem.
Just a standard question, would you mind sending out, or PMO send out this presentation afterwards?
Yeah, I'll send it to the organizers and then they can send it out.
Thank you.
To have everybody. I made some changes I sent a prior version, but I'll send that to everybody. All right, that's it for me.
Well, Brian, thank you for lending your expertise this afternoon. It was certainly informative. We appreciate you sharing your time and your knowledge. Want to thank as well all of our meeting invitees and attendees. Thank you for your time and the questions and the dialogue. As noted, the presentation will be posted at the SharePoint site as well as the recording. So look for that soon. And that information.
Oh, sorry, I missed the ones in the chat thing. Where does AFUDC go on the balance sheet? So we actually, that goes into our PP&E balance. So we record, it's basically like a negative interest, or record an income for it, and it gets capitalized. So it increases our capital balance. And then we'll recover that in the future through a rate case or transmission formulas. Yeah, the cost of the building generation is considered also. Seeing the share. Yep. Okay. Now that's officially it.
Okay, well, thank you for catching that. That must have been sent directly to you. I did not see that in the chat. So thank you for addressing that, Brian. We appreciate you. So if there are no further questions, as noted, we will share the content in the recording. And we appreciate everybody's time. We will give you back almost a little over 10 minutes of your time this afternoon. Again, thank you everyone for your time. Have a great afternoon.